Hello, good evening. And please, I hope each and every one of you is fine.
By God's grace, we okay.
All right, sure. Today is another day for us to continue with what we started yesterday as part of our preparation towards the ICAG March 2026 examination. It is very important that we start our class very early. This is a pre-classes, something that we do for our students to ensure that they are always ahead in class. And please, if you have any question, you can unmute yourself and then talk. If there is a need for you to use the gestures, like you can raise up your hand or something, please do so. But if you raise up your hand and then I don't see it, you can unmute and then ask every question that you have. So yesterday we started with the conceptual framework when it comes to public sector accounting and finance, where we made mention that we are looking at the principles, the basis that governs the preparation of financial reporting, general purpose financial reporting. And then we also came to the conclusion that everything we are going to do under the conceptual framework is centered on 8 chapters where it follows each other. So you are supposed to know the 8 chapters. We were able to go through the first 4 chapters. That is, can someone give me the chapters? Mr. Ampri, can you list the chapters for me so that we take it from there? Let's do a quick revision. Mr. Ampri. Mr. Ona, can we talk about the 8 chapters?
Yes, sir. The 8 chapters.
Yes, sir.
We the eight the rule authority of our framework.
Yes, sir.
Objects of the financial reporting.
Mr. Ampri, your network is very bad, so I don't know if you are far from your phone or something. Please check your connectivity and then start again.
Okay, so I wasn't the one that was speaking. It was
Oh, okay,
Haruna,
sure.
I guess.
Okay, Mr. Aruna,
So
I don't know if you're using earpiece or something. Your voice is far small. So if you can start.
Okay, can you hear me now?
Yes, we can hear you now, bro.
I was saying the chapter 1, role and author of the conceptual work.
Yes, sir.
Then chapter 2, objects and general financial reporting.
Yes, sir.
Quantitative characteristics. And then chapter 4, reporting.
Yes.
Yes. Chapter 5, elements in financial statement.
Yes.
6, recognition financial state.
Yes.
Chapter 7 of asset ability financial. And the last one, the 8, presentation general financial.
Okay, that is fine. In fact, you have nailed it all. And we made mention that we have the chapter 1 to chapter 8, where we started that the chapter 1 is made up of the rule and then the authority. So the rule has to do with we coming up with a framework that underpins the preparation of general purpose financial reports. The chapter 2, we are saying that the authority, that is, the conceptual framework does not establish an authoritative requirement that override, how do you call it? the preparation of general purpose financial statement by entities that adopt what IPSAS. And then we went on to look at the objectives of the general purpose financial report, where we said that we have two main objectives. We have the decision-making objectives and then the accountability purpose or accountability objective. We also looked at the uses of general purpose financial reports, where we said we have the primary uses and then the other uses. We were able to talk about their specific role that they play or their information need. So yesterday we were able to talk about that all the way to chapter 4. That is reporting entity. So if you say reporting entity, we are basically talking about an entity that prepares general purpose financial statement. And we said that for you to be called a reporting entity, you must meet you must have some features. So we said these are the features that a reporting entity must have. So that is what we discussed yesterday. So yesterday, we started from chapter 1 to chapter 5. Today, we are going to continue from our chapters. So we have chapter 5, which is the elements of financial statement. So when you take the financial statement, Mr. Ampi, have we seen a financial statement before?
Yes, sir, I've seen one before.
Okay. Mr. Albert, you are welcome. We started not long ago.
Yeah,
We just
thank
went
you.
over what we did yesterday. So we are about to start today's class. So you have not, we are yet to start. So you are on track.
Okay. Okay.
So we are saying that we have something called elements of the financial statement. So when you take the financial statement, we have some elements. We have the assets, the liability, the equity side, and then the rest. Now, bear in mind that some of the terms that we use in the financial reporting that we know, they are going to be different from the terms that you are going to use in the public sector accounting. So please, let's bear in mind. So the first element that you are going to look at is called asset. It's called asset. When you say an asset is a resource presently controlled by an entity as a result of past events from which future economic benefits are expected to flow to the entity. So if we say an asset, let's say in a layman understanding, it is something that will bring you money every day. Please, I hope you understand. It is a resource that is presently controlled. Like you should be able to control it presently as a result of past events. And then that event is supposed to give you future economic benefits. So that is asset. That is an asset. When you go further, you realize that you have various forms of asset. You have the non-current asset, we have the current asset and the rest. Moving forward, you come to understand the various classification of assets. So if we say assets, we are basically looking at what? A resource that is presently controlled by an entity as a result of past events. So that is that. That is that. Any question before I move on? So when you say asset, just have it in mind that something that puts money in your pocket. So if it is, let's say, a construction company, you realize that, or let's say a quarry, you realize that you have the drilling machine. So the machines fetch you money every day. So those things, we call them an asset. If it's a quarry company, most of them, they have cars that transport the gravels or the sand or something to their customers. So the car becomes an asset to the company. So that is asset. Please, can I continue? Now, let's talk about
Yes,
liability.
please.
If we say liability, have it in mind that liabilities are owings, like monies that you're supposed to give to someone. Sometimes they cannot be money, but they are services that you're supposed to render to someone. When you qualify it in monetary terms, you call it what? Liability. It is supposed to be a present obligation, something that if you do right now, it is going to result in an outflow of what? Resources. So if you do it, right, if it's something that if you do it, it is going to result in an outflow of resources. You will use money to pay for it. You are going to use services to pay for it. So if you say liability, it is an obligation that an entity is supposed to fulfill as a result of what? Past events. So a past event, let's say you've gone to borrow a desk. You went to borrow a desk last year, and then the obligation is for you to pay it the following year. As a result of that past event, that is the purchase of what? The table. Presently, you are supposed to give out something. You are supposed to what? Give back to the owners of the table. So something is coming out of you. So that is what? Liability. I hope you understand. So it's either money moves from you, or you use services to what? Pay for those events. Please, I hope you understand. That is what? A liability. Can you proceed? Can you proceed?
Yes, sir.
Yes,
You
sir,
can
we
proceed.
can.
Okay. Mr. Ampre, please, do you have any question?
No, sir.
Okay. Okay. Now, we have what is called revenue, expenses, ownership contribution, and ownership distribution. I didn't provide definition to this one, but I'll update the slides and then send you the definition. But you're going to talk about it in class. Now, anytime you take the public sector notes and then you are those that they have accounting background, if you are defining revenue and then ownership contribution, sometimes you tend to what um I don't know how to say it. You tend to use ownership contribution definition for revenue and revenue for ownership what contribution. Please, when you say revenue, see it like something that brings like your daily sales. Your daily sales. Have it in mind that revenue is your what? Is your daily sales. That is one thing that you are supposed to know. So when you say revenue is an increase in the net financial position of an entity other than increases arising from ownership contribution. If you say ownership contribution, they are the monies that are contributed by the owners of an entity, like their shares, their retained earnings. They will say that, oh, instead of you paying us dividend, let us invest this amount in the business. That becomes ownership contribution, the contribution of the what? The owners. So if we say revenue, it is the increase in net financial position of an entity. So our daily sales, but this time around, other than what? The increases that arises from what? The ownership contribution. So they are the monies that you receive from our daily operations, but they are different from the monies that are being contributed by what? The owners. Please, I hope you understand. And then when you say distribute expenses, you're talking about the decrease in the net financial position of an entity other than decreases arising from what? Ownership distribution. So ownership distribution, if I've mentioned that we have ownership contribution where the owners will contribute funds to increase their stake in the company, then ownership distribution, the money that the entity distributes to what? The owners. So a typical example is what? Dividend, the money that you pay to them. So, Mr. Albert, what is net financial position? What is net financial position?
So net financial position will be that's the difference between the asset and then liability. I don't know if I'm correct.
Can you please come
That's
again?
taking your that's taking your assets minus your liabilities. I don't know if I'm correct. That would be the net financial position.
Yeah, so when we say net financial position, we are looking at a snapshot of your financial health. That is the difference between your own assets and what you owe. So after taking your assets, your liabilities from your assets, that becomes your net financial position. So an increase in that net financial position can be our sales. I hope you understand. So once there is an increase in our net financial position, other than ownership contribution or contribution coming from owners, we say they are what revenue. But always in layman understanding, have it on your mind that revenue is like our sales, our daily sales that we generate from our business activities. I am going this down because of Mr. Humphrey, since he's not having an accounting background. But those with accounting background, you realize that you only need the definition to remember things. Now, so the expenses are also, we have discussed the expenses already. When you say ownership contributions are inflow of resources to the entity contributed by external parties in their capacity as owners, which establishes or increases the interest of the net financial position of what? Of the entity. So ownership contribution, they are the inflows. They come as a result of what? Inflows to the entity, money that you receive as an entity. But this time around, they are coming from external parties in their capacity as owners. As a result of them being the owners of the company, they end up giving us money. They give money to the entity. And once the entity is receiving money, it becomes an inflow to the company. I hope you understand. And as a result of that, it is going to increase the net financial position of the entity. So the vice versa of this, the vice versa of ownership contribution is what? Ownership distribution. Is ownership distribution. So the ownership distributions are outflow of resources as that is distributed to what? External party in their capacity as owners, which decreases an interest in the net financial position of what? Of the entity. So if the ownership contribution is increasing the net financial position of the entity, then the distributions that you are making to the external parties in their capacity as owners is going to reduce our net financial position. So that is all about the element of financial statement. So we have the assets, we have the liability, we have the revenue, we have the expenses, we have the ownership contribution, ownership distribution. So there has been instances where I think last the last date, March 2020, it was July, I think July 2025. They asked the students to explain, is it asset? No, I think they asked them to explain what is called I will check the past question and then send it to you. I think it was about a resource that is presently controlled by an entity. They told the students to write about something. It was about asset or something. I'll check the past question and you will see how they set the question. So that is that for the element of what? Financial statement. Now, chapter 6, we are talking about recognition of elements in the financial statement. Recognition of elements in financial statement. So we've come to understand that we have elements of financial statement. How do we recognize them? How do we display them on the face of of our financial statement. So if we say recognition, we are looking at the process of incorporating and including in amount displayed on what? The face of what? The financial statement. And it's supposed to meet the definition of the element before you recognize an amount as asset, as revenue, as liability, as ownership contribution, as ownership distribution. That amount is supposed to what? Meet the definition of an element, and it should be measured reliably. It should be measured in a way that can achieve the qualitative characteristics that we talked about yesterday. And also, in terms of measuring the qualitative characteristics, we have to take into consideration the constraints on what? The information included in the general purpose financial statement. So in all, we are saying that recognition is a process of incorporating and including in an amount displayed on the face of the appropriate financial statement an item that meets the definition of an element and can be measured in a way that achieves the qualitative characteristics and takes into account the constraints on information included in the general purpose financial statement. So before you recognize an amount to be an asset, the, the amount should if the amount should what be presently what it should be a resources that is presently controlled by an entity as a result of what past event, and that amount is going to result in what a future economic benefit to what the entity. So before you say that this is an asset, this is a liability, this is a revenue, it is supposed to meet the definition of what? Of an element that is an asset, liability, revenue, ownership contribution, ownership distribution. And it is supposed to be measured in a way that achieves the qualitative characteristics. If you take the amount, you should be able to compare it. The amount you should be able to understand the reason why you have that very amount. It should be faithfully represented. It should be of relevance. You are supposed to have some confirmatory and predictive value, as we indicated yesterday. I hope you understand. And then the constraints, you have to look at the cost benefit. Will you be able to justify your cost and your benefit? The materiality aspect of it. If you omit that amount, how is it going to influence your decision making? I hope you understand. Is there a balance? Is there a trade-off between your qualitative characteristics? So that is all about what recognition. So before you recognize an amount as an asset or a revenue, you are supposed to meet this recognition criteria. And then the recognition criteria is already stated in our definition that that amount or that item should satisfy the definition of an element and can be measured in a way that achieves the qualitative characteristics and takes into account constraints on information included in the general purpose financial statement. So with the recognition, you cannot just write anything. The truth is you have to know it off head. You have to know it off head. Whatever that you are learning, you have to know them where to work. So the first aspect of it is that it is an amount that is displayed on the appropriate financial statement. And for it to be an element, is supposed to for you to be able to recognize it, it should be able to meet the definition of what an element. It should be measured in a way that achieves the qualitative characteristics. And it takes into account the constraints on what information included in the general purpose financial statement. So once you come to realize that it is supposed to meet the definition of an element measured in a way that achieves the qualitative characteristics, it take into account the constraints of information included in the general purpose financial statement, you are done. Because this side is giving us the recognition criteria. This side is giving us the recognition criteria. So once you know the recognition criteria, you are done with your definition when it comes to recognition. The only thing that you are supposed to attach is that is the process of incorporating and including an amount displayed on appropriate financial statement. So if it is your statement of financial position, if it is your statement of cash flow, before you recognize an amount to be what current asset, now current asset, ask yourself that does it meet the definition of an asset? Does it meet the definition of a revenue? Does it meet the definition of an expense? Once it meets the definition, fine. Can it be measured in a way that takes into account the qualitative characteristics that you talked about? And then does it take into account the constraints that is included in the information, the general purpose financial report information? That is that. Please, any question before I move on? I think I've really spent a lot of time explaining this very thing to you. So if you have any question, please let's take it from here before we proceed. There is something that I want you to know, and this is it. All items that satisfy recognition criteria are recognized in the financial statement. Recognition involves an assessment of uncertainty related to the existence and measurement of the element. The condition that gives rise to the uncertainty, if any change or can change. Therefore, it is important that uncertainty is assessed at each reporting date. Now, listen, in some circumstances, an IFSAS may also specify that to achieve the objective of financial reporting, a resource or obligation that does not meet the definition of an element is to be recognized in the financial statement, provided that it can be measured in a way that meets the qualitative characteristics. So, Mr. Those that joined yesterday, you realize that we said the authoritative requirement is that the conceptual framework does not provide an authoritative requirement. It does not mandate that it is not mandatory that IPSAS should be done this way. I hope you understand. We said that IPSAS is having its own ways of doing things, but the conceptual framework is going to guide us to come up with the IPSAS. So if that is the case, there should be no mandatory framework that the IPSAS should be done this way. So this one is saying that sometimes the elements will not meet the definition as you stated here. But according to IPSAS, there is a way that we can recognize them. Therefore, we should recognize them on the face of our financial statement if they meet the qualitative characteristics and its constraints. So you realize that it is a build-up. It is a build-up. It is a build-up. It is a build-up. Please, do you understand, Mr. Ampre and then Mr. Osman?
Yes, sir.
Mr. Osman, you will be my course rep. I agree, sir. I want to hear your voice, sir. Mr. Osman.
Yes, sir.
You will be my course rep, sir. I will disturb you, so you will be the one to be helping me to call your friends. I will disturb you at dawn. Yesterday, you didn't join my class. You came to give me an excuse. In fact, I think you were in a car. I think you were in a car, so I've already forgiven you on that. But moving forward, you have to join class before myself. I'll join the class. So let's take it from there. Your very good friend, Mr. Ampre, is not having accounting background. So both of you, I'll put you in one group.
Okay.
I'll put you in one group. Then you disturb each other for me.
That's okay.
Okay, sir.
I've understood.
Please, sir, do you have a question?
No, I don't have.
Okay, sir. So for you, because we didn't join yesterday, let me give you an overview, then I'll move to the chapter 7. So that if I'm asking you a question, you won't come and say that you don't know or something. I'm giving you everything that we're supposed to know. So yesterday, we started with conceptual framework. And if we say conceptual framework, we are looking at the principles that guides us in what preparing our general purpose financial reports. And we said everything that we are going to do here is centered on each chapters. It's centered on each chapters. These are the chapters. The chapters follow each other. So we have to move from chapter 1 to chapter 2 up to chapter 8. So everything that you are doing is what? Is the 8 chapters. Yesterday, we were able to cover up to chapter 4. So you take the note, you realize that the video is already shared on our YouTube page. So you can go to the YouTube and then just have access to the video. Moving forward, I'll also try my possible best and see if I can post it on your Telegram channel for you. But because this is a pre-recorded classes, you want all the members to benefit. So that is why you post it on YouTube for others to also benefit. So yesterday we were able to discuss up to chapter 4. Today we've done elements of financial statements and then you've moved to chapter 7. That is what we came to meet us doing. So now it's left with 2 chapters for us to finish. If this very topic is supposed to come in March 2026, that it is going to be 10 marks. They can pick the question from any angle. There has been instances where students are being asked to write on all the 8 chapters, or they can possibly pick some of the chapters and then they will ask you questions on that. My mandate as your facilitator is to ensure that after the topic, we take all the past questions, you go through all the past questions that are the questions that are being asked on this very topic. We solve them before we move to the other one. Please, I hope you understand.
Yes.
Also visit the ICAG question bank. We solve the questions in 8 and then we move to the next chapter. This is to ensure that you, the students, you solve all the questions in the question bank and the past questions before you go and then write the exams. So you know what you will do. So that is that. So chapter 7.
Thank you very much.
Chapter 7, we are looking at measurement. Chapter 7, we are looking at measurement of assets and liability. How do we measure our assets? Now, if you say measurement, broadly, measurement is about attaching monetary value to an element, attaching monetary value to your asset and the liability, attaching monetary value to your asset and liability. When it comes to assets, what is the objective now? This is the first thing that you're supposed to know about chapter 7, the objective of measurement. The objective of measurement is to select those measurement bases that most fairly reflect the cost of service, operational capacity, and financial capacity of an entity in a manner that is useful in holding the entity to account and for decision making. Now, when you say cost of service, what is cost of service? Mr. Ampri, what is cost of service? Mr. Albert, what is cost of service?
Yeah.
Okay, Mr. Ampri, please let's go.
So my understanding is the cost that is charged for a particular service that is rendered.
Yes, the cost that is charged for, yes. Now, when we say operational capacity, let's say I want to come, let's say we have a machine or you have a laptop. The capacity of the laptop to operate efficiently to assist you to join the classes means that operationally your laptop is what? Efficient, right? So when you say operational capacity, we are looking at the capacity of the entity to what? Support the provision of services in future periods through physical and other resources. And then financial capacity is the capacity of an entity to what? Fund its activities. So now, When you say the objective of measurement, measurement, already I've told you that measurement is attaching monetary value to what? An element. So our objective is to select a measurement basis that fairly reflects the cost of service, the cost that we charge for the services that we are rendering. That is also going to reflect the operational capacity, the capacity for us to support the provision of services, and then our financial capacity. So always our objective of what? And then this very part, they've been repeating it part in the past question, this part and then the recognition part. Always you have to have it in mind that your objective is three under the measurement criteria is to select basis that fairly reflects the cost of service, the operational capacity and financial capacity of an entity. Even if you write up to this side, you are going to be marked correct. The only thing that you're supposed to know is that you bring this side, that the objective of what measurement is to select measurement basis that fairly reflects the cost of what service, operational capacity, and financial capacity of an entity. So this side alone, if they bring it, it can be 5 marks. If you're able to explain this, you then go ahead, explain this side, the cost of service provided in the period in historical terms or current terms, operational capacity, the capacity of the entity to support the provisions of services, and then financial capacity, the capacity of the entity to fund its activity. This side alone, they can bring it for 5 marks or 10 marks, and then that's about what conceptual framework when it comes to the exams. Now, we have measurement basis for assets and liability. We are going to take the asset first, you go to liability. When you say measurement basis of assets, we have numerous or various measurement basis for assets. We have historical cost, we have the market value, we have replacement cost, we have the net selling price, we have value in use, and then I think we have more, but in your notes, this is what you have. Once we share the ICAG manual with you, you go through, if you see more, you have to also build on that as well. If we say historical cost of an asset, now you either purchase an asset or you develop an asset. If you want to buy an office table, if you are a carpentry, you are an entity that is into carpentry, you develop the asset yourself, right? So the cost that you are going to incur in developing the asset is called your historical cost. If you want to buy a car, the cost that you will pay, the consideration that you will pay to acquire the car is your historical cost. So if you say historical cost is the cost, the consideration given to acquire or develop an asset, and which is cash or cash what equivalent or value of other consideration given at the time of acquisition or what development. So that about what historical cost. That is that about historical cost. So historical cost is basically the cost that or the consideration you give to what acquire or develop an asset. Please, the note is also detailed. So when you go to the note, you realize that you have the historical cost, initial measurements, and the rest. You come across it, so you take it from there and then we read it. We have what is called the market value. Now, when you say market value, here you can also call it the fair value. If we say market value, we are saying that it's an amount for which an asset could be exchanged between two knowledgeable parties, willing parties in an arm's length transaction. So now, market value, fair value, when you go to the market, you can exchange your asset at a very price, at a certain price. But this time around, the parties are supposed to be knowledgeable. You should have idea about what the market, that this is how the transaction is supposed to go. This is how the transaction is supposed to go. Fair value. Those that with FR background, you realize that this is the general definition for fair value. So it's supposed to be a transaction that everyone is willing to give out something. You give and then you take. And everyone is supposed to be knowledgeable about the transaction. You have to have a broad idea about the transaction. So if you say fair value, it is the amount for which an asset could be exchanged between two knowledgeable parties in an arm's length transaction. In principle, market value provides useful information because they fairly reflect the value of an asset to an entity. The usefulness of market value is more questionable when the assumption that markets are open, active, and orderly does not hold. So those that you are going to read IFRS 18, that is fair value. You'll be you'll be learning about what a market that is open, a market that is in an orderly manner, and a market that is active. You're going to learn about that. So that is that. And then we have replacement cost. If we say replacement cost, it is the cost that you incur to replace the asset. The cost that you incur to replace the asset. That is that. We have net selling price, the money that you obtain from the sale of the asset. But this time around, you should deduct all your costs to sale. So if you want to sell your table, at the end of the day, you are going to incur some cost before the table will get to the final consumer. So the net selling price, that's the sales value, the amount that you are going to get from selling that price after you have deducted all your cost to sale or cost of sales. That is net selling price. And then you have value in use. Now, value in use. When you say value in use, let me use our normal computers as an example, or even our mobile phones. Assuming we have a mobile money shop, you have a young phone, right? You are going to use the young phone to operate your mobile money business. So you are going to present value that phone, that young phone. You are going to present value it that if I use this phone for let's say 5 years, the phone is going to generate me 10,000 Ghana cedis or 1,000 Ghana cedis. That is value in use. So the value, the potential service value that you are going to generate from the use of what of the asset. A typical example is Asanka. When you go to um, how do you call it, the choba, you realize that they have Asanka. So the Asanka is going to be used to serve the customers. You present value the amount that you're going to generate from the Asanka. You present value the amount to today's term. You present value the amount to today's term that this is the amount that I'm going to get from the Asanka after using it for 6 months. That is value in use. So when you say value in use, it is the present value of it is the value to the entity of the asset running service potential or the ability to generate economic benefit if continued to be used and the net amount that the entity will receive from disposing it. So the amount that you also get after disposing it is part of what your value in use. So you have to present value the amount that you're going to generate from the use of the asset. If it is 5 years, you present value the amount to today's term, and then the amount that you get after selling it. That is value in use. And then we have measurement basis for liability. Measurement basis for liability. Now, if you say liability, we've already stated that liability is what? Is an obligation that will result in what? An outflow of resources as a result of past event. So the historical cause of what? Let me give you a general overview before I even read this one, the historical cause. So historical cause of a liability, when we say historical cause of a liability, it's like the amount that you receive when you took an obligation or a debt. So an amount that, let's say you're going to a bank for them to give you 10,000 Ghana cedis. That is the historical cost of what? Of the liability, of the debt. But you know that the loan that you're going to take will come with an interest. The interest is not part. You are looking at only the 10,000 Ghana cedis of what? Of the loan that you're going to take. That is the historical cost of the debt. So historical cost is a for a liability is the consideration received to assume an obligation. So the 10,000 Ghana cedis that you're going to borrow from the bank is what the historical cost of what? Of liability. Of liability. We have cost of fulfillment. Cost of fulfillment. So when we say cost of fulfillment is how much it will cost to settle a liability. So cost of fulfillment is like paying off a debt or fulfilling a contract. The entities try to estimate this cost, considering all possible scenarios to come up with a fair amount. So cost of fulfillment, we are looking at what? The cost that you incur to settle a liability, cost of fulfillment. So the cost of fulfillment, when you say cost of fulfillment, is the cost that an entity will incur in fulfilling the obligation presented by the liability, assuming that it does so in the least costly manner. So you have to take into consideration all the costs that you incur in settling the liability. That is cost of fulfillment. Cost of fulfillment. So, and a typical example of cost of fulfillment is that assuming you are a company that has a warrant liability, the cost of fulfillment will be the estimated cost of repairing or replacing product under warranty. So cost of fulfillment is like you providing your customers with warranty that if the product I'm going to provide to you is of defect, I'm going to replace it for you. So that is cost of fulfillment, the cost that you incur in fulfilling an obligation. That is cost of fulfillment. And then the market value also comes here, the fair value or the market value of a liability. So the only difference is that when you say the market value of an asset, is the market value is the amount of asset could be what? Exchanged. Asset could be exchanged, but here it is saying that for which liability could be what? Settled. Liability could be settled. So the only difference is that asset is the amount for which what it will be exchanged, but here the liability is going to be what? Settled between two knowledgeable parties in an arm's length transaction. That is the only difference between the market value of asset and market value of what? Liability. And then here too, we have the net selling price of liability or the cost of release. Net selling price or cost of release. So that is also that. That is that. Apart from that, you also have assumption price. So assumption price is the same as replacement cost in what? In this one, in liability. Assumption price. So the assumption price is like, let me give you a normal example for assumption price. So the assumption price is like, let's say you're going to borrow 10,000 Ghana cedis. By the end of the day, you sell the liability to someone for 9,000 Ghana cedis. So that amount becomes an assumption price. Assumption price is either going to be, it is going to lead to an increment or it is going to lead to a loss or like a profit. So it's like you selling off your debt to another entity or another person. That is assumption price. So the cost that you incur to assume a liability, that is assumption price. That is all. Now, we have the chapter 8, which is presentation. And when you say presentation is very simple. It's like you having your financial statement. So if it is assets, we have non-current assets, we have current assets. So presentation is you placing them at their various destination. So you have to put them at the place where they belong to. You cannot put non-current assets under current liability. You cannot put non-current liability under current assets. So presentation is talking about the selection, the location and organization of information that is reported on the general purpose financial statement. So you select the amount or the item that this is an asset. If this is an asset, which location is it supposed to go? Is it going to be a current asset? Is it going to be a current liability? So you send it to its appropriate location, and then it's supposed to be Like you're supposed to organize it in a way that is going to be very presentable. That is all about what presentation. So presentation is about selection, location, and organization of information that is reported on the general purpose financial report. That is that. Any question? Any question?
Please, what's the difference between the
Please, your network
the
is very
light and that of asset?
your network is very bad. Can you come again?
I was asking between his two under the and the assets.
Can you use the chat box for me? Can you use the chat box so that I can read from there?
Okay.
Mr. Humphrey, please, any question? Mr. Osman, please,
No,
any
sir.
question? Mr.
No,
Albert, any
for now, there's
question?
no question.
Okay, Mr. Albert, any question?
No, sir.
Okay. But please, you understand the explanation, everything that I'm saying, you understand?
Yes, yes.
Yes, sir.
Okay. Mr. Aruna, I'm still waiting for your this one. Historical cost under asset and liability. So the historical cost of assets, we are saying that the historical cost of an asset is the amount that you are going to pay to acquire the asset. So if it is a table, the table is, let's say, 10,000 Ghana cedis. By the end of the day, you are going to transport it to your office. It will come with transportation cost. That transportation cost is not part of the table. The 10,000 Ghana cedis alone becomes the historical cost of what? The asset. The amount that you incur in acquiring the asset, the amount that you incur to acquire the asset or just to develop what the asset is, what is the historical cost. So if you are coming up with a table, you need the wood, you need the glue, you need the nail. Those things are what the historical cost. Once like the table is formed, the cost that you use in what developing the table becomes what your historical cost. And the liability is the amount that you receive to assume a liability. So if you go into a bank for them to borrow you 10,000 Ghana cedis, the loan will come with an interest. We are not looking at the interest side of what the amount that is the yielded amount or something. We are only looking at what the actual amount that they've given to you, the 10,000 Ghana cedi loan that the bank has given to you. That is the historical cost of what the liability. Please, I hope you understand. Mr. Haruna, please, do you understand now?
Yes.
Yes, so when you say liability, so it is a consideration received to assume what? An obligation. So the 10,000 Ghana cedi that you have received to assume that debt that is going to be on you is what? Is the historical cost. I hope you understand. And then the historical cost of an asset is the consideration that you're going to pay to acquire or develop an asset is what? The historical cost of an asset. So we have come to the end of how do you call it, the conceptual framework. Our target is going to be the past questions. So we are going to take some years. I'm not going to mention the years to you to go and then revise them. I'll just pick them. You go to the website, we pick them, and then we just answer them. So please, as you are going, today we spent only 1 hour. You just have to go and then revise your notes. Once we take the past questions, we start solving. So by the time you even go to class, you've already done about 30% of the syllabus. Then we take it from there. So our agenda is to finish about three how do you call it, past questions tomorrow. If you're not able to do everything, you put a hold to the past question and then we start a new topic. Before Monday, you can join your IFRS class or something. You are also going to have IPSAS class where the IFRS madam will take you through. So that is also there. You have IPSAS class, you have IFRS class starting from Monday. The standards that you're going to do, you're going to treat the same standards in class. So you just have to ensure that it is going to be what you are going to learn it very well. So that if you have any question, we take it from there. You can ask your madam in class because it is the madam that is going to even take you through the IPSAS, the general class. Madam is going to take you through the IPSAS. Ideally, she was supposed to take you for the public sector accounting, but because of her workload, I decided to step in and then take you guys through the public sector accounting. Moving forward, if there is any course that you don't also understand, if you have challenges, you can just send it to me. Some of the courses, it's been a long time I studied them, but I'll still find my ways and then assist you. Still find my way. Please, any question for me today?
Tomorrow we'll do the classes tomorrow.
Yes, we are going to meet to solve our past questions on conceptual framework. So please, I think yesterday's class was 1 hour, 40 something minutes or so. I didn't check the time, but it won't be up to 2 hours. So what will happen is that you can just go and then listen to it and then we take it from there. And then the actual classes to what you are going to do is, Mr. Osman, you have to even remind me when you start the actual classes. Mostly the recordings are going to be 1 hour, 1 hour, so that if you are at the office and then you are revising you are going through your video, you won't feel dizzy or you won't feel lazy watching the video. You can watch it for 1 hour, you pause, and then later you come and take another video. So always remind me that I'm going to pause the video every hour, then we take it to the next level as well. So let's say in a day, you are going to have 3 videos coming up or 2 videos. Maybe you can decide to do it 1 hour, 30 minutes or 1 hour, 1 hour. So if it is 1 hour, it is going to be 3 videos. If it is 1 hour, 30 minutes, it is going to be 2 videos.
We'll do that.
We are also going to meet at dawn. As for the dawn studies there, we are going to meet at dawn. So once you come from work, if you know you are quarreling with your wife, you just go to bed. Once you call you at dawn, you pick your phone, you take your book, and then you go and study. So the dawn classes, you also have our dawn classes. Mr. Ampre, any question?
No, sir.
Okay. Mr. Albert.
So no question.
Okay. So tomorrow we are going to, in fact, we start from 2019. You start from the olden days, then you move to 2025. So we are going to start from 2019 past question. But I don't know which year you are going to end at. So we can target about 2019, 2020, 2021. We solve these 3 past questions and then we take it from there. If you are not able to do it, we are going to solve 2. We will check all the settings, we are going to solve 2, then we take it from there. We move to the next chapter. So our next chapter is going to be the PFM cycle. The PFM cycle. The PFM cycle is 20 marks, so we take it from there. So please, can you call it a day? And do you have any question? Do you have any general question to ask? You can ask, then we provide you with answer concerning the classes and everything. So, Mr. Osman, yesterday I made mention that if you don't have the ICG manual, don't worry. You find ways of getting with the manual. Just that once we share the manual with you, you also don't have to share it. So we are going to try our best and get you the manual.
Okay.
Yes. When you begin class, we are going to share the manual with you. Sometimes you can do it first 100 pages. As time goes on, we send the other 100 pages like that. So we finish the course.
We are most grateful.
And then you have the learning materials as well. The materials are very detailed. So with that one, even if you rely on the materials, you are good to go. You realize that everything is coming detailed from the ICAG manual. So once you take the book, you realize that you don't even have to use the book. Maybe you only refer to the book for more details, but once you take the learning materials, you realize that it's very deep. And then those that you've joined other classes before, you can testify. Once you compare the materials to other tuition centers, we realize that you have differences. Some of them will provide you with just the definition, but once you have they will just provide you with their point. Once you have the definition, you rely on it and then you go and write your exams.
Yes.
So if there is no question, you can call it a night. Please, if you have any special issue, you can message me, you can call me on phone. We talk about it.
That's it. Thank you very much.
Okay, sir. Thank you.
We are meeting tomorrow, 8 o'clock p.m.
Okay.
Okay.